Yes, fortunately, inflationary trends are very favorable. As we can see, in the CEE region, inflation has come down to about 5%, down from the peak of about 16%. The similar is the situation in our case, in Macedonian case, where inflation has come down to around 3% from the peak of close to 20%, which of course reflects strong monetary policy tightening. I would say there are two specific features that stand out during this tightening cycle of the monetary policy. First, that it has been the most synchronized monetary policy tightening cycle in the last 5 decades. And second feature, that it has been also the most aggressive tightening, where the central bank has reacted twice, on average twice, the historical pace. So I would say it does not come as a surprise that we are already seeing visible effects in the inflationary trend as credit activity has slowed down. In some economies, it has been even in negative territory. In CEE region, still positive and solid, I would say about 5%, but obviously, there has been a tightening of the financial condition with visible effects on the demand side. But even more importantly, having in mind the nature of this shock, it's positive that we are seeing that especially long-term inflationary expectations have remained anchored, and we all know that they are one of the important factors that shapes the inflationary developments. Still, I think as central bankers, we have to be humble, as this was not a standard monetary policy shock. There were a lot of factors at play, including a lot of supply side factors. We saw disruption in production, disruption in trade, in transport, skyrocketing energy, food prices, so all of these factors contributed. And when we saw stabilization of these factors, easing of these factors, this of course had a positive implication for inflation. Nevertheless, trends are good. However, I think it's still early to proclaim victory, as a lot of uncertainty remains around us. The recent crisis, I think it's a good reminder of delicate mandate situations in which operates central banking these days. We saw that the tightening of the monetary policy can have adverse implications for the financial stability, especially if it is aggressive, as it is. It is synchronized, as it is, and especially if it comes after a prolonged period of low interest rate that tend to be conducive to higher risk taking. Luckily, there were the risks that we saw and the financial stress that we saw on the markets remained contained, which can be explained broadly by two factors. One is swift and strong reaction of the regulators, and the second is the fact that strength or resilience of the balance sheets of the banking system that was significantly built, increased in the pre-pandemic period. So, key factor for avoiding major financial crisis, I would say, is resilience of the banking system that was built in the past. And looking forward, it has to remain the name of the game.